What up, Pod Squatters? I'm Anita Wong.
And I'm Tiffany Lee.
We're investors, real estate agents, and the co-hosts of SARE Ladies, the girl power arm of subtle Asian real estate.
Every episode will feature funny, casual conversations with dope AF participants killing it in the real estate game. But also mostly people like you and me, just trying to figure it out. Stay for the drama and lulls. We're not pulling any punches.
But first, a word from one of our fabulous sponsors.
Hey, SARE Ladies listeners, Tony the CPA Dude here, also your resident SARE Tax Bro. And with your lovely host, they came up with some great ideas. So Miss Tiffany and Miss Anita here came up with the tax workout plan. So we're gonna help you get cut up on your taxes, also gonna help you cut up on your own body. So just like working out, taxes is a monthly thing. You can't ignore it, otherwise you're gonna fall off the cliff. So with the code SARE Ladies, we're gonna give you a nice healthy discount, and we're also gonna give the SARE Ladies a kickback just to help support their podcast. I've had a fun time being on their podcast a couple times this year. They've done great. I really want to see them blow up in 2023. So with your support with this creative tax workout plan and also a workout plan in general, we're gonna help you transform your life in 2023. So mention the code SARE Ladies when you talk to me. You can email me at Tony@the CPA Dude. Text me at 928-CPA-Dude. TikTok's the CPA Dude. Website's the CPADude.com. Everything's the CPA Dude. So SARE Ladies is your special code here, and let's make this year great.
Now on to the show.
Hey, Pod Squatters, and welcome back to the SARE Ladies podcast. This is your host, Anita Wong and Tiffany Lee. So this is our part 2 of year-end tax strategies with our friend here, Tony Hoong, the CPA Dude. And if you haven't checked out the first episode, please go back to it. It's linked in our show notes, because today we're diving into advanced tax strategy, where Tony will be taking over. And at the end, we're going to be sourcing live questions from our community to ask Tony. Hey, Tony.
Howdy. What's up?
Welcome back. Welcome back to, what has it been, like 5 minutes?
Solid, yeah. 7, yeah.
7 minutes. If you guys are living under a subtle Asian real estate rock and don't know about Tony Hoong, who's our go-to tax pro, here's some background on the CPA Dude. The CPA Dude is a strategic tax firm that focuses on educating and actually being there for their clients. Tony Hoong helps keep you, his clients, out of jail by filing your taxes and finding ways to shield your income from Uncle Sam. So without further ado, we're going to kick this back over to Tony, who's going to expand on advanced tax strategies this episode, like STR loopholes, cost segregation, what you can do as a real estate professional, deduction audits, appreciation assets, opportunity zones, and finally, writing off your lifestyle. So without further ado, welcome back, Sensei Tony.
Thank you. Thanks for having me back. And just always grateful for the opportunity, but we can dive right into it. I'm sure folks want to hit this tax and say F you to Uncle Sam. So let's go with a short-term rental loophole first. So short-term rental loophole, this is probably the best, shouldn't use definitives again. This is one of the most popular strategies for the SARE community. The reason why is that it actually allows you to write off your W-2 income. So for the folks that don't know about the short-term rental loophole, it's pretty much where you go get a short-term rental, put on Airbnb, VRBO, whatever you call it. And there's a couple prongs that you need to meet. And the first prong is, the average of 7 days or less is your average stay throughout the whole calendar year. So have that part done and track it and calculate it. So you can probably like hack it where you do like 8 30-day stays, and then remaining 4 months just do a crap load of like 1-day stays. So your average goes all the way down. So just to have less headache in your head to deal with all those folks. So that's number one. Number two is that you need to meet one of the 7 prongs. And one of those 7 prongs is probably the easiest one is you worked 500 hours on the property. Or number 2 prong, you don't have to meet both, just one of them, is you worked 100 hours on the property and no one else worked more than you, aka you can't have a PM. So generally those two prongs. There's a super gray one, don't recommend, but it is in there. It's it boils down to you pretty much did everything. So there's no hour tracking. You do track your hours still, but no one else did anything for the property. So those are the top three ones that most people meet. Then finally, you need to run a cost segregation on the property. And this only works on property that you placed in service in the current year. So either this year or next year. Run your cost segregation. And the reason why you need a cost segregation is because a rental property by default is 27 and a half years of depreciable life. And bonus depreciation only works on useful life of 20 years or less. So you need this study to separate into buckets of 5, 7, 15 year, so you can depreciate all in the first year. And why it's a loophole is because like in the 1980s during tax reform, Section 168, they came out with this part where it's more so made for bed and breakfasts. So it's like treating it as like a real active business, hence the 7 days or less component of it. And because it's active, you actually can offset active income with active losses. So your W-2 is active. Now the short-term rental is active. So you just front-loaded all your depreciation in year one, and it'll offset it on your W-2. So kind of tying this all back, just give you all the theory. Probably no one's listening anymore, but you have, so a real client example is they bought a unit in Arizona, $800,000 purchase price, extract land out 20-25%, whatever you call it, ran a cost seg on it, and it was a $80,000 year one depreciation. So they will take $80,000 against their W-2 assuming they have a lot more losses because they had to furnish it and get ready and all that stuff. So $80,000 extra loss on their W-2, and say if you're in a 30% tax bracket, that's $24,000 that you would have just paid Uncle Sam if you didn't do this. So it kind of helps fund probably all your furniture into place, kind of funds your not that much of a down payment, but $24,000 is still a lot. Well, at least for me. I don't know for all the other rich folks in SARE. But yeah, that's the short-term rental loophole. So hopefully that kind of gives a gist on that part. And then as always, if there's more questions, we're always happy to answer that. Or the SARE folks are so smart. They just ask someone else in SARE too.
Stop it. They can ask you, Tony.
Yeah.
I feel like you covered like half of it with that answer already. Like you knocked out STR loopholes, cost segregation, and real estate professionals by kicking it over to people in SARE. And I think you touched on deduction audits too.
Oh, there's more. Oh, we can go way more. So cost seg.
Go into it. Let's go.
Oh, we can go more. Yeah. So cost seg, going back to point one, it doesn't only apply to short-term rentals. You can actually use this just for your normal real estate. And you would just, instead of taking all in year one, you would just take it over their better useful life. So once again, default 27 and a half years, passive loss, passive activity. But if you can separate it into 5 year, 7 year, 15 year buckets, now instead of, say you have $100,000 divided by 27.5, say you separated out 15,000 divided by 5, right? You're accelerating all your depreciation in the first 5 years of that, 7 years and 15 years. So it's just like taxes, it's always robbing Peter to pay Paul. And what I say for a cost seg is it worth it or not? So I think the term gets thrown out there a lot. I think social media is really good at promoting it, but it may or may not make sense for you. And the reason why I say that is that it might run you $2,000 to $6,000 to execute it. However, if you don't have the real estate professional status, which we'll touch on next, or the short-term rental loophole, you accelerated all these losses, and you make less than $150,000. So you accelerate all these losses, but it doesn't do anything for you in year one. You just pretty much captured all these losses into a fake bank of losses that you can use in the future. So it may or may not make sense for your situation. Obviously that's where the whole tax plan comes into play. Because say if you liquidate a property, though, you say you're going to sell property, you don't want 1031 it, you don't want to opportunity zone it, you just want to cash out, then a cost seg could actually make sense because you can take all the losses from the cost seg against that gain. So there's multiple ways on how you can use a cost seg. It's just very fact dependent, but that's just kind of like one example of how you use cost seg when selling a home, cost seg when using a short-term rental loophole. And then we can actually probably lead into the real estate professional part too, using cost seg.
Actually, before we get into it, I just want to make a teaser. Actually, and after Tony, we're going to actually have a dedicated cost seg person to be coming to talk to everyone, since it's such a big topic, and it's hard for, I guess, Tony just to be covering the whole breadth of it. So if you haven't gotten enough about what's cost seg and all these kind of things, catch us on our next episode, and we'll definitely elaborate on that as well.
Nice, perfect. Yeah, that's the true pro. Like, so actually how cost segs work is that, so CPAs generally conduct them, but they're super specialized and you need an engineer to do it. So like, we don't do cost segs because like there's legit whole standalone businesses that do cost segs. We report that for the folks that do it. So your cost seg person will serve it to me on a silver platter, and then all I do is I take it out from the depreciation schedule, put it onto your tax return, attach the cost seg study so it's properly documented for the IRS. But yeah, so how you can also pair this with the real estate professional status. So you two lovely ladies have a nice status. So real estate professional status, for folks who don't know, but once again, SARE, they probably know, but it's simply put 750 hours is like prong number one. And number two, where most people fail, is that you substantially work in this activity alone, more than 50% of your time. That's the hook that gets everyone. So you generally won't be able to be a W-2 working in tech or working your day job and be a real estate professional, because that's not your true activity of what you do. Like so me, for example, let's just use me as an example. Like, I can sit on this podcast, talk to you ladies more than 750 hours a year about real estate, talk about real estate strategies. But even if I have 3,000 hours, my true intent is I'm actually a tax person, right? I just happen to be talking about real estate. So it has to truly be, rather just selling, developing, managing. Those are your biggest ones within the real estate professional status of how you can claim it. So you truly have to have the intent towards it. It's just not possible to get the best of both worlds. But that's where you go marry a real estate professional. And, heard Tiffany may or may not be on the market for that. So
advertising.
Yeah, that was going to be my next question, right? So if you can't claim that our rep status, the real estate professional status, the next best thing is to marry one. And for real estate professionals, right, it's hard to get a loan because our income is so inconsistent. So the best move for us is to marry a W-2. And then you can claim the best of you can get the best of both worlds from a tax strategy perspective. It's an advanced tax strategy perspective.
Yeah.
But yeah, everything.
Get your partner in crime and life, get loans, crush the world, make passive income, and just go travel. Like, boom, Tiffany's got it down. I see your strategy.
There you go.
Yeah. Yeah. So real estate professional status, really big. Actually had, I just worked with her 2 nights ago. It was over, we got there between being a real estate professional, running cost segs, buying a crap load of properties. We got their tax bill down to 3% of their overall AGI. So there's crazy power just on it. So virtually almost paying no tax, like 3% is inflation.
Do you think it's easier to do that by being married or being single? Like, what is the upside? While we're on this is the fun side of advanced tax strategy, and Anita hates it when I bring it back to dating, but we're tying it back to taxes. So Tony, can you just elaborate on that? Thank you.
Yeah. It would be, preferential generally. If I could like make the best tax scenario. So say if this was a game, right? But it's not. We're talking about like real lives here, real dating lives. Say if this was like The Sims or something. And if I could structure it where we have one big income W-2 earner, because you afford the stability, they will actually give you loans, and you can have that as the base to fall upon. And then you get married to a real estate professional who, I'd say it's easier if we take it from the management of properties. So all you do is that W-2 person over here just feeds more properties to the other spouse. And then all they do is manage the properties, because that will fall for a real estate professional status. So they just manage the properties. It's still passive in nature, right? It's not that much hard work. You still need 750 hours, but then all the losses here offset the W-2, and then pretty much you just wiped away all the W-2 workers' taxes.
I love that. Hey
Yeah.
guys, I'm single. Big W-2 earners. Hit me up. Holler. I got the 750 hours. Don't you worry, babe. I got you.
Unlimited losses.
That's the hook, yeah.
All right.
I mean, that
all
has
right.
to go on your Tinder profile, Tiffany. I mean, it's like can do
Only the
unlimited
high
losses.
net worth babes will understand what I bring to the table. But yeah.
Just put the HNW or the UHNW into your profile. If they get it, they get it. If they don't,
Ooh, I like that.
yeah.
That's it. All right.
Yeah.
All right. Next up, we're going to talk about deduction audits.
Yeah. So deduction audits. This is used. We primarily use this more for folks that are self-employed, but it does help at least one time from a real estate side. So what this simply is just sitting down with like a tax pro that knows deductions, or if you can frame it in your world where it says, is this expense ordinary and necessary for this business? So is this ordinary and necessary to be a realtor? Is this ordinary and necessary to be a rental property expense? Ordinary and necessary to be a CPA, right? So what you do is just go through all your bank statements and your credit cards, and we just sit with our client one by one, each transaction, ask them what it is. There's personal expenses on there, obviously, too, but we just make sure that they're not missing out on any of that. So one example is that we had, they were a photographer, and their subject matter was food, but then they were just eating the food, and then they weren't writing off the food. So then through food, travel, and we found $27,000 of expenses for a whole year. So missing out on that. So just sitting down and just having your tax pro help you on, hey, can we do a deduction audit? So it's simple, but it's actually very effective, just because you don't know what you don't know. And just having a pro help you on that actually helps. So that's the deduction audit for everyone.
Love that. All right. So moving on from deductions, let's talk about appreciation assets. Is it appreciate assets or appreciation assets?
Appreciated assets, probably. Yeah.
All right, appreciated assets. Let's go.
Yeah. Yeah. So appreciated assets on this side of items is, to keep the example simple, is say you bought Facebook stock, $10, your own cash out of your own pocket. Now it's appreciated to $110 just because you held it over time. You're like, oh, Facebook is great, but you're like, Zucks kind of sucks. I'm just gonna donate this to a charity. You get that $110 deduction as a charitable contribution. So one, that's the theory, right? You bought something for low, it appreciated, you donate it for high to a charity. And this is like one of our more tried and true strategies for our folks that are high W-2, but we do this via art. And through real estate, you can do this via land conservation easements. So both have it where you either buy art or you buy land, and you wait for it. You have an in-house appraiser, not in-house, but the art one has an in-house appraiser. You probably have another appraiser for the land. But say you contribute $20,000 to art, and now this appraiser appraises the art 4x the multiple. So you have an $80,000 write-off now. You donate it to the charity, and if you're in let's just say a 30% tax bracket, what's the benefit? It takes over a year to procure, so you need economic substance. But say you invested $20,000, held it for a year, it went up to $80,000, and now you donate it, and you're at 30% tax bracket, that's a $24,000 tax benefit. So now you gained $4,000, right? So you put in 20, held it for a year, donated for 24. Same thing for land conservation easements. This kind of just hit the I think it's like the naughty list of the IRS though. Like it was, it got flagged. But same concept though. I think this because they didn't held their land for more than 12 months. But what it was that you invest into a partnership, put in 50K, and then their values were crazy. They're like 10x. So you'd be a $500,000 deduction. And then you write that off on your taxes. And once again, if you did $500,000 at 30%, you know, at 150K tax benefit. So just the differences in scaling it and the magnitudes. But this is that charity hat that I kind of touched upon earlier too. It's like that's you accelerate, you defer, or charity, but accelerated, appreciated this way. So another cool way to offset income if you don't have other choices.
That's wild.
I have a personal question, I guess, with that, since we're talking about charity, and something I've been trying to learn about is CRTs, or charitable remainder trusts, where I heard you can pay yourself an income based on the charity that, you know, so can you elaborate what like those kinds of vehicles are, charitable remainder trusts?
Yeah, so charitable remainder trust. So where I think possibly that one, or you may be thinking about the private family foundation also, but essentially same concepts. Both charities, that's how the tax code's written to your advantage, right? But essentially you donate your funds to this company, you take the fat right off, and then either there's some form of kickback. So there's different styles. So there's charitable remainder trust. There are, what do you call it? They're generally managed by funds. And those funds go in and invest the dollars and then kick you back the money one day. But these funds just keep on growing, and the money never gets kicked back to the charity. You get the money still, but the charity actually never gets anything. That's why they're kind of, they've been kind of like brought up into light, because the biggest financial institutions that are managing the CRTs, they're not actually giving the money to the charity. So like Elon Musk is like part of this too. And he's, you know, donate all his money over there, not all, but a good chunk, so he can defer taxes or write off taxes. So there's that. There's also the private family foundation. This one's probably a little bit cleaner and easier, but generally what happens here is, once again, you make a fat donation, and then you have family members executing out what your purpose would be. So, you know, so say if we wanted to do something, you know, within the Asian community, hey, this private family foundation helps the people in SF China now not get beaten up because they hire security people. So like hiring out your friend's family, that could do that. So there's that those are two types of the charities that happen. There's also other ones that you can donate your stock or your house even, and you sell it within the trust, and all the gains are tax-free. Because so now you have this, so you put in a $200,000 house, you sold it for $2 million. That $1.8 million is completely tax-free, and then you're able to get a kickback every year. So they look at your, they have these IRS tax tables, and it's pretty much see we're going to die. It's how much they're going to pay you over time. And then the quirk of it is how much is left by that time goes to that charitable organization of your choice. So there's other ways on that, especially if you want to be giving what's the fancy like PH word? That's philo something. I can't pronounce anything. Yeah.
Philanthropist.
Philanthropy.
Yeah, that one. I can't pronounce it. Yeah, English second language, but yeah. Philanthropy. Yeah.
Okay.
Hey, we're going to take a little break, but in the meantime, here's a shameless plug for one of our amazing sponsors. Dr. Hua Win and her husband, Dr. Jaime Gonzalez, both optometrists by trade and owners of multiple multi-million-dollar optometry practices in the Dallas area, founded Black Steel Investment Group with a passion to invest to impact. With the foundation forged on 3 pillars, integrity, community, and legacy, they put their investors at the forefront of everything they do. The couple are both seasoned, full-time, multi-family investors, syndicators, and asset managers who, together with their investors, have invested in over 6,900 units as general and or limited partners in Texas, Arizona, Florida, and the Carolinas, with total assets valued at over $480 million.
Juan and Jaime are always working to find new investment opportunities for their investors. The couple enjoys traveling the world for delicious food and interesting cultures with their 8-year-old daughter Athena and have a puppy named Coco Ollie.
Next.
Sorry. Oh wait, can we go back one step? Because the appreciated assets, we were talking about the art appraisal, and that was sticky to me. Like, I feel like that's kind of a little bullshit and gameable. Like, can you expand on that? Because that seems really funny to me. So how is that legit?
Yeah, so I thought the same. I thought the same. So we found a partner firm who actually helps us execute the strategy. And I was just, because in the CPA world, it's trust but verify. Like, I can trust you two all day, but I'm not gonna like sign off on anything till I verify it myself. It's just being a professional about it. So how it works is that how it's kind of controlled, right? They have like antiques, like old books, old art, and they procure it themselves. Like that, the company procures it, and then they have their appraiser. I think this is where the gray part comes in. On the appraiser side, and then they 4 or 5x the multiple of like, hey, what's the true fair market value of this book, just because they're like ancient artifact type of items. And then the quirk on how I got comfortable behind this is that there's like Harvard tax attorneys signing off on a white letter on this, so just attaching all this documentation for when you do file with the IRS, then you can sleep easier at night. But tying it back to the basic premise is it's appreciated. So that gray area is where it comes from, the appreciation. So Facebook stock, easy, right? $10 you bought it for, it shows on your brokerage report. Go sell it or donate it, fair market value. You can literally look it up just because it's a public stock. That's where kind of it gets gray within like, hey, how good is that appraiser's report? And it really ties into that.
Interesting. So I can't take like my niece's 5-year-old finger painting, like my 5-year-old niece's finger painting, and be like, "This is the art that I bought. Doesn't it look like a Jackson Pollock?" Like, I can't just write that off.
Yeah. So you definitely, that's also why it takes over a year to do, because they see it as an art investment actually. So you just can't like slap this on, go buy tomorrow, invest 20, you'll get an 80K benefit. You got to hold it over for a year. But no, I think it's subjective in terms of how do you determine the fair market value of that appreciated asset? Because it could be. I was for Thanksgiving, we took the moms to the San Francisco Modern Art Museum, SF MoMA, whatever it stands for. And then some things I was like, I never thought that was art. I'm like, guess that's art. So it's just, I think it's open to interpretation. It's such a gray space.
Yeah, I've heard that. Like, I read in like the Wall Street Journal about like how art is that. I mean, okay, maybe not. I mean, now that crypto's around, but like the last frontier of unregulated, like objective sort of tax breaks and stuff like that. And that's why you see like billionaires like putting like art in the Broad Museum, making it for public, and also like donating like millions and millions because they're writing it off, and also
seems like bullshit. I can't wrap my head around it.
Yeah, that donate millions to a trust where they get a managed brokerage account, right? Like, is it really donated?
Yeah, and I didn't realize, they're not actually giving it out to the charity. You just say, like, they're a credible, institution. Of course, they're giving out the money to charities, but I guess they don't do it on a scheduled way. Also, they make the determinations on their own when to give it out. So, yeah.
Yeah, that's the wonky part, because like the manager's supposed to deem it and like give it out, but sure, that manager is an inside person. Like, it's just another world that the ultra rich live in. Yeah,
I'm gonna bring another person on that one for our podcast, because that's an interesting topic to me, because I love art and stuff. Anyway, cool. Yeah. All right. So next one, opportunity zone. Can you talk about that for advanced tax strategies?
Yeah, so opportunity zones, this is good for deferral. So it's a no deferral strategy, just like how 1031 is a deferral strategy. But opportunity zones, essentially, it came out of the 2018 tax reform. And what it allows you to do is pool your money into this fund. And this fund is able to go invest into, lack of better words, distressed properties. So through the census, they designated like these properties in these areas throughout the whole US. that you're able to invest in, and then all that money in that fund is deferred for 5 years. But the stipulations are going to be weird because it's supposed to sunset in 2026. So, but essentially what you can do is, say you sell off your home. This also works for stocks or crypto. So back in the day when crypto was a thing, is that you could pour all this money into a fund and you can defer all your gains. You don't have to pay any taxes on it. And then you go invest in this property. And then this property just, makes your rent. You get deferred income. So rob Peter, pay Paul again. So pretty common area for if you have a lot of capital gains, or also you just don't want a 1031. The downfall of it is that they're not the best properties. The whole, like, all tax codes written generally to promote like some type of policy. And the whole point of the opportunity zone is to put an influx of investment into these bad areas. But I mean, like, a bad area in the Bay Area still not that bad. Like, it's still an okay investment, but there's some definitely rougher parts of like where you can see the opportunity zones really trying to bring back these neighborhoods that kind of just went south. So that's like an opportunity zone is if you have a lot of capital gains from work, your stocks, or from your selling a property, it's a good way to defer funds.
I have a question about opportunity. Oh, okay. Anita, you go first.
Both of us. So I heard about opportunity, and this is a new thing that I've been learning about. It's the EB-5 program. Have you heard of this before? But apparently, like, foreign investors can obtain a green card by investing $1 million in an opportunity zone. Have you heard about this?
Really? I've not heard about. Yeah.
I have a client that actually, we have a property out in Oakland, and it's an opportunity zone. And apparently, if you let's say if you work at Google and you are looking for that green card, I'm just saying this might be a very interesting opportunity to skirt those long lines. I've just started learning about this actually.
Oh, wow. So wait, you can more or less buy your green card? Wow.
Please talk to a real estate please talk to a real professional about it. I am just learning about this policy, but I heard it's a recent thing.
Yeah, who's an immigration attorney in the crowd? Yeah, slide into the DM. We need to learn more.
Yeah, your boy Tony. Don't you have attorney?
David.
Let's ask David. Get him on the podcast.
Oh yeah, we need to. Yeah, we need to. Yeah, because he's business real estate. I should ask him about immigration. He's a smart dude. So yeah, that's cool. Because like it makes sense from a tax side of things. Because opportunity zones funds are always LLCs, and LLCs can be owned by foreigners or aliens on that side. Well, for U.S. purposes. So not in the bad way. But yeah, because S corps you can't have anyone outside.
Yeah. Well, Davis, if you're listening to this, we have to follow up about EB-5s because I'm super interested. Because, I heard that you can market offshore, and then people can take a shortcut to getting those green cards to the U.S.
Yeah, and to piggyback off of that EB-5 thing, right? As investors, can investors investing in a development project that's working in an opportunity zone, can they get the trickle down effects of that from a tax perspective? So if you're working with a developer who has a project in an opportunity zone, can you kind of fall under that umbrella because you're investing in that project?
If the fund, if the fund does it, yeah. So actually, that'd be funny if we got like actually, this could be like a fractional subproduct. So fractional creates a opportunity zone where everyone pours their capital gains into, or just funds it generally, and then goes buys these distressed properties. And then Tiffany sounds like she's got the plug for the developer. And then just one full circle.
It's like, how do you set up an opportunity zone? Or it is already designated, right? It's already designated by
it's zoned by the government, right? Or whatever the zoning ordinance is. So basically you already have that map, and you can just search for properties within those opportunity zones and create development projects around that. And then say to these investors, hey, you want a tax break? Here's a cool development opportunity that you can buy into. And here's how we set up the tax plan for it. And Tony's kind of like running the show with the tax parts and make sure that we all kind of like get the tax benefit off of it. This is me basically spitballing. Tell me if none of this is correct, Tony.
We're gonna have to
thinking creatively about it.
No,
I feel
it's
like
honestly been that census
the
tract. Yeah.
yeah, I feel like there's like something ticking right now, but we're gonna have to follow up on that. So don't quote us. We're gonna have to elaborate this on the next episode, everyone.
Yeah, no, that's that's the best part about tax. It's very creative. So like it's when I first started taxes, I feel like,
Would have
oh,
never
it's
thought.
easy career, black and white, just follow the
Truly.
rule. Next thing I know, oh man, this is gray as crap. I'm like, God dang it. Yeah.
We're all gonna get arrested for a white collar crime. Getting too creative here.
Oh yeah. Man, I don't know. Just as a side note, on the DOJ, like there's some sentences on there, the Department of Justice, for white collar crimes is almost worse than killing someone. Like some of these sentences are worse than like murdering folks. I'm like, oh my God. Like, yeah, don't commit like any white collar crimes. Like hard pass on that.
I feel like, yeah, all right, unpopular take from Tiffany, but I
Yeah.
feel like white collar crime, like I feel like I'm always in danger of accidentally committing a white collar crime just
Uh-huh.
because my brain is wired to like look for loopholes in systems, and it's kind of unfair to get punished for just being smart.
Oh. You're like, I can do it all day. Just don't throw me in jail. Yeah. It's yeah. I think as long as you're creative within a legal confine, totally cool. Yeah. But insider trading is always like the ones you always see on the DOJ. It's like, come on, man. Can't hide anything in today's world.
That's why you need checks and balances. I get a little too creative, and Anita's like, no, you can't do that.
I'm sure
Dynamic duo.
I'm sure Bernie Madoff has the same exact thought. Right? It's like I'm just being creative. I mean, it's why should I be punished for this for being smart?
I'm just an evil genius. Why are you punishing me? All right, cool. So last item, writing off your lifestyle. Let's talk about that, Tony.
Yeah. So like this is kind of like another tax plan part, that we talked on like the earlier episode. Just like you need a plan, like say you got nothing to work with, you gotta get creative like Tiffany. So writing off your lifestyle is kind of like another area where we kind of help clients. So like from starting their business and making it legitimate. So none of this is like flagged or as a hobby or anything. But what I mean by this is just how much of your daily life can you double dip as a business expense? So if you're renting out your place, you rent your home, deducting part of that on your taxes, right? So you got your home office because you got to hustle. You got your cell phone, you got your insurance, you got your car, grab some mileage on your car also. And then like some meals, tack on some travel in there because you're doing some business development. So all these things that more or less you do in your daily life already, if you can spin it as a business expense, then it's pretty much a haircut and a discount for you. So if you think about, say, if you take the effective tax rate of someone in California, New York's actually a terrible state too. We're for taxes. It's a great state, terrible for taxes. Before I just crap on your state, but it's a 30% effective tax rate between federal, state, city, and that means for every $100, it's actually a $30 deduction from your life. So everything's pretty much 30% off if you can write it off. So say if you want to become an agent, right? Well, actually, bad example. I'm not going to encourage more competition for you. But say if you're like a content creator, like you're an influencer on TikTok, and you're like, wait, pretty much, it's kind of a gray area, right? But a lot of it from like, hey, the media equipment that you're using, or your subject matters, your clothing, your hair, your nails, if it's legit and used for ordinary and necessary, you always have to tie it back to, is it ordinary and necessary? But you can write off all these items that we're going to have to use anyways. So it's just a big 30% write-off on this hypothetical. So how much of your lifestyle can you bake in to write off? So like me talking to you on this mic, on this computer, on this camera, on this mouse, like it's all write-off. So pretty much almost like a lot of it is just how creative you can get. That's legit.
So let's say if you make foot content on OnlyFans, can you write off your pedicures?
Yeah, I'd say that one would be legit. Yeah, just
that would
make
be
sure
legit. I'm
solid.
just saying.
Ordinary and necessary, Boom. Yeah. You're spot on,
Yeah.
Anita. Yeah.
Well,
I just learned.
Tony, you do have OnlyFans clients, right? What are they
Oh my
right now?
God.
He does. Didn't you touch on that on our last
We
episode?
just talked about it during Friendsgiving with Tony. Tell him how much people make and tell him you don't need to do real estate. You just need to do OnlyFans.
Yeah. There's folks that are 6, 7 figures doing OnlyFans. It's
Crazy.
mind-boggling to me, but I'm like, dude, just not gonna knock it. You're like doing better than me in my life. like it's just wild from the pure amounts that they make. But also OnlyFans takes 20%, which is like, oh wow, what a great business model. But yeah, the things that they write off, a lot of it related to lifestyle. What's their lifestyle? What's their brand persona look like? Their content that they produce out. But yeah, always tying it back to that ordinary necessary. And it's a very gray space, and there's not been a lot of guidance from the IRS because it's just the guidance is so old. The tax law does not really have anything to go back on. So just more so, but a lot of it has to be legit, right? Having your receipts in place, your right documents. If you go out to eat, you go out to travel, who, what, when, where, why, documenting all that. Documentation sucks. No one likes it, but you actually need to do it, especially with like all the new agents that are currently trying to get hired. So they had that, that one headline, 87,000 new agents with the budget for, but I mean, they can't find anyone anyways. They found people, but it's, they're not going to find 87,000 people overnight. Like the accounting tax industry is super shortage. So yeah, until we cross that bridge.
After our Friendsgiving conversation, all I could think about was like, what if I just put my next 5 down payments on using foot content? Like that would be so worth it. I would
That'd be
like,
boss.
that would be
You do have
so
nice feet.
fun.
You do have
Yeah.
nice feet.
Right,
There we
thanks.
go. That's now that's the next. that would be probably the best TikTok like John, like you're just like, hey, this is how I funded 5 rental properties, and just what properties you got, what you had to do to do it. Yeah.
Yeah. Oh my God. Wow. That'd be great. Okay.
All right.
Well, we're running out of time and we still have a few questions left. So we're going to speed through these. Okay. So questions from our community. Can you explain what tax harvesting is and what do your wealthiest clients do?
Yeah. So tax loss harvesting, simply put, big fancy words to say sell your crappy positions in the stock market or in crypto. So it's for stocks that, you don't think will come back, or you're just like, I'd rather just lock in the loss to reduce capital gains, or I just want the cash. So a year-end tool is just to be like, hey, I have all these realized gains from the year. I can sell off these bad positions and then actually offset your capital gains. So just more or less getting rid of your bad positions. Probably, for sure hit up your wealth advisor on that. And then from crypto, you're actually able to sell all your positions, rebuy back, and not be subject to wash sale rules. So if you're kind of like still bullish on it, another quick quirk on there. But that's kind of what tax loss harvesting does for the wealthiest clients. If they're in those portfolios, generally their wealth advisor takes care of it for them to take care of that. So yeah, pretty simple concept, and it's just a good way to clean out stuff. But at the same time, it's like you're technically losing money. So like up to you on how much you want to lock in. And then also don't sell off a crap load expecting that'll like offset your taxes. So say you sold off $50,000 of it and you're like, oh, I'm locking $50,000 loss. You only get $3,000 per year. So the remaining $47,000 would be carried forward into the future. So it's not bad, not great, but something to do.
Something to do.
Awesome.
Great.
Yeah. All right, next question. One of our sorority sisters asked, where do you source your information on all the updates from that's for tax code for any non-CPA people?
Yeah, so this one's hard because like we subscribe and pay for like tax research software. So they send out like a daily newsletter to us. So I just read that. And then also I do continuing education. So like we have to do 40 hours a year. So like this actually could be available to anyone. You can go to, so they're called CPEs. continuing professional education. Look it up for tax. And I think our subscription is like $250 a year, and you can probably just lock in on those for yourself if you want to learn some. It gives you good high level, but it doesn't give you the how to. So they give you the theory, but you need someone like Tiffany who's creative with items and be like, how do you actually use it? Also, that's why you have a tax pro generally. Do they like bounce ideas off of? So generally, a lot of times we have a lot of collaboration with our clients. They'll just like, hey, saw this, what do you think? And I'm like, oh, nice. Because like I don't see everything. I only see like so much. So it's always good to just collaborate with your tax pro.
Yep. Too long didn't read. Just hit up a tax professional. Stop trying to learn everything yourself, guys. Like that's crazy. Just focus on your lane and delegate to the pros. All right, Anita, kick us off with the last question.
So Alan Lee asks, I know that for consulting businesses, electing to file as S-corps can reduce self-employment taxes. Does this still apply for most real estate businesses? If so, are there any differences if you're primarily getting rental as opposed to other income?
Yeah, so no, this is really good. Like S corps are great because they serve as self-employment filters. However, you only want to use them for active businesses, active income. The reason why is serves as a self-employment filter. So if you put all your rents into an S corp, you're gonna have to pay self-employment taxes on it, which kind of defeats the whole purpose because it's passive income. So general rule, rental income should be in an LLC. Active income in an S corp. So if you're, consulting business, great. For being an agent, great, S corp. A management company, great. But just if you're just collecting rent, just keep it in an LLC. Otherwise, you're going to overpay in taxes.
All right.
Awesome.
Thanks, Tony, for
You're
all this
welcome.
amazing advice. We're at time though. But if you guys at home, listening at home, want a personal consult with Tony Hoong, you can find him on his website, which is thecpadude.com, or you can text 928 CPA Dude. Email him at Tony, Tony, at thecpadude.com. Or you can also follow his TikTok channel, which is so funny, so amazing. It's at the CPA Dude. So those are the multiple ways you can get in touch with Tony. Thank you so much for joining us. It's always a pleasure having you on the show. Woo!
Thank you for having me. No, always fun with you ladies.
Thanks for listening. But before you go, we've got a quick subtle Asian real estate update for you.
Want to learn how to invest in real estate but don't know where to start? Then be sure to check out SARE's 30-Day to Buy a Home Challenge webinar series, where we teach you how to get from 0 to 1 on your first or next property. Our 6-part series begins airing on December 6th on Facebook Live and YouTube. Let's ring in the new year with your new house. Happy buying!
Thanks for hanging with the SARE ladies. Until next time, bye!